Most people could be making way more money in the stock market if they just changed 5 core beliefs. The first belief is considered to be common knowledge, but it is 100% wrong. Most people think of investing like shopping on Black Friday. The second you hear about a deal, like there's a flat screen TV, 70 inches, it's 50% off. By the time you get there, hundreds of people have already swarmed in and scooped up all the good deals, and now you're left with just a bunch of normal priced televisions. Basically, the market is so competitive that the moment a stock is on sale, hundreds or thousands of people swarm in, scoop up that stock, and when a lot of people buy a stock, the price goes up, and now it's just a normal priced stock. And there's an academic justification for this belief called the efficient market hypothesis. Basically states that it is impossible to consistently beat the stock market. You can't win. Whether or not a stock is going to overperform or underperform is random chance. This hypothesis is a cornerstone of modern financial theory. So how can I possibly say that it's wrong? Well, the problem are in 2 of the big assumptions that this hypothesis makes. The first one being that everybody who participates in the stock market has access to all of the available information to make decisions off of. And this may be true for the best hedge funds in the world. Maybe they have access to all of the possible information that they would need, but not everybody falls into this category. There are tons of retail investors, people like me, who do not have access to all of the possible information. And even though I have access to tons of information on the internet, tons of people don't utilize that information. Many people approach investing like they approach gambling, where they're not making buy-sell decisions based on the strength of the company, the financials, or the fundamentals. They're looking at what are people saying about the company, or they're looking at what is the chart patterns for this company. They're going to places like Reddit Wall Street Bets to see what other investors are doing. So retail investors make up a big chunk of the trading volume in the stock market. About 20% of all trading volume goes to retail investors. About 50% goes to high frequency algorithm based trading, which is getting its signals based on retail buyers and sellers. Maybe the best hedge funds in the world have access to nearly all of the possible information, but not everybody participating in the stock market falls into this category. Retail investors are just random individuals who are buying and selling stocks. These make up 20% of the total stock trading volume. These people do not have access to all of the possible information for the companies that they're investing in. And we do have access to tons of information on the internet, but most people are not even utilizing the information that they do have available. Many people approach buying and selling stocks like gambling and not investing. They're not making their buy-sell decisions based on the strength of the company, the financials, the fundamentals, the company's future prospects. They're looking at other factors like the short-term chart patterns, or they're going to websites like Reddit Wall Street Bets to see what are other people doing. So there are tons of people out there, a huge chunk of the stock market that does not have access to all the available information and are certainly not making their decisions based on the information that they do have. The second fatal assumption is that everybody participating in the stock market is acting on all of this information in a perfectly rational way. And it doesn't take long to think of some counterexamples for this. All I have to do is think back to the meme stock craze where companies like GameStop, Carvana, Bed Bath & Beyond, AMC, BlackBerry, these companies shot up multiples, sometimes overnight, only to come crashing back down shortly thereafter. These companies had massive changes in stock price, not based off changes in the company's quality, but based off a social phenomenon. These companies became memes and their prices moved because of the insane momentum that was created out of greed on the way up and then fear on the way down. And it's not just individual companies that are susceptible to this kind of stock movement. We have a long history of stock market crashes where the entire market crashes way down as investors are fearful. They pull their money out, and then we see the market recover in the coming weeks, months, or years. And it's not just individual companies that are susceptible to these kind of price movements. We have a long history of stock market crashes where the entire market sinks as investors are pulling their money out due to fear. And then we see the market bounce back very quickly, sometimes in months. It is possible for us to beat the stock market as long as we do our due diligence. We actually take advantage of the vast amount of information that is available to us, and we keep our emotions in check. That way we can take advantage of individual companies that do fall well below their intrinsic value because of fear in the market, and we stay away. We do not buy when companies are pushed up too high out of greed. But there is a bit of a trap here for investors who are looking at the overall market as being too expensive. This is the second harmful belief that we need to change. It causes investors to miss out on hundreds of thousands of dollars because they're too scared to invest at all. When you're looking at an individual company, it is reasonable to determine that a company could be too expensive to buy at this time based on the information at hand. But when you apply that same logic to the market as a whole, and you decide that the market is too expensive and it's too risky right now to invest, this is a missed opportunity and this is a harmful belief. The first problem with this belief is that the overall market does not reflect what's happening with every individual company. It's like saying in LA, the average restaurant is too expensive. That may be true, but that doesn't mean you can't find a few gyms out there in LA. You can find a few restaurants here and there that are really delicious and they are reasonably priced. The same is true with the stock market. Just because the overall stock market is very expensive and the average company is very expensive, that doesn't mean that there aren't individual companies out there that you can find that are reasonably priced and high quality. The second problem with this belief is that the cards are always going to be stacked against you. The news cycle is always going to be skewed towards the negative. People are always going to be predicting the next stock market crash because this is the kind of news that gets clicks, the kind of news that gets views. And if you are choosing not to participate in the stock market because there's a general sense of risk, then you're going to be constantly missing out on opportunities. The best returns are found in the market when the stock market is dropping, the news cycle is incredibly negative, and investors are making emotional decisions based on fear. That is when stocks go on sale. Even in a falling market, there will always be some companies that are rising in value. There will always be companies that have stronger fundamentals than ever, even though their price is falling. And those are the best companies to invest in. I have to ignore the noise and continue to analyze each company as an individual investment. If it becomes undervalued, then I'm going to buy. If it becomes too overvalued, then I'm going to sell. But this next belief often stands in the way of that simple idea. It tricks investors into selling their stocks prematurely and leaving lots of returns on the table. Many people believe that you should start taking profit when a stock increases in value by a certain amount. Like, let's say my stock's gone up by 50%, well, I should sell some to take profits. Or if my stock has gone down by 20%, then I should sell it to cut my losses. There's also people that say if a stock now takes up too big of a percentage of my portfolio, I should trim it back. Let's say I have 10 holdings and I want each one to take up roughly 10% of my portfolio. If one stock grows so much that it's now 15%, should I sell to trim it back down to 10? All of those reasons to sell are very surface level reasons. What really matters is whether or not the company is a good investment today. The price that I originally bought the company at is completely irrelevant to the question of, is the company a good investment right now? And this is a really hard belief for a lot of investors to shake because there's a strong psychological connection to my entry point. The first step is for us to just be aware that we have this strong psychological bias towards the price that we originally bought a stock at. If we can be aware of that weakness, then we can beat that weakness and stay laser focused on buying and selling companies for the right reason based on their value today. This next belief is incredibly common and it seems logical on the surface. The belief is that if I want to beat the masses, I have to go against the masses. And this plays into my real world experience, which makes it hard to let go of this belief. Like if I'm sitting in traffic and I want to get to my destination faster than the guy next to me, I'm not going to beat him if we're both sitting in the same traffic. I got to take a different route if I want to get there faster. And it's tempting to apply that logic to the stock market. But if we look at the most popular companies over the last few years, Amazon, Apple, Facebook, Nvidia, these companies have performed incredibly well. They have destroyed the market despite being very popular companies in the market. If I applied this belief, then I would have spent tons of time searching for tiny, obscure, unknown companies to invest in. But that takes lots of time. The important thing is to find high quality companies that are currently at a good price. Just because these 5 or 6 companies are incredibly popular, it doesn't mean that they won't have periods of time where they are a fair price. Once again, this belief is tricking investors into making investment decisions, not based on if it's a good company at a good price, but based on factors that don't really matter. Whether or not a company is already popular doesn't truly inform us if it's a good investment. What matters is the current price of the stock, the current profitability, and the future profitability. These are the only three factors that we need to take into account before deciding to invest in a company. But even if investors are able to execute perfectly and stay laser focused on evaluating the value of a company, many will still fail. This next belief causes investors to quit altogether, or worse, completely blow up their portfolio. The real problem is having unrealistic expectations. There is a harmful belief that I can make a lot of money very quickly in the stock market. And it's tempting to scroll websites like Reddit Wall Street Bets and see plenty of stories of people who made millions of dollars overnight and think that I can recreate their results. But the truth is, those people are more akin to gamblers. For every one success story, there are 100 failures that do not make it to the website. It's like going to the casino and trying to win big. It makes for a flashy story, but it's not a reliable, repeatable plan. When your expectations get out of sync with reality, that is when greed sets in. You tend to make more risky bets as you're trying to make a lot of money very quickly. But the stock market rewards patience, not speed. There's a famous quote that says the stock market is a machine that takes money from the impatient and gives it to the patient, and that could not be more true. Take Warren Buffett as an example. One of the greatest investors of all time. He averaged 19.9% returns per year over the course of his investing career. But even if I was able to recreate that level of success, if I invested $1,000 a month with those returns, it would still take me over 15 years to make $1 million. That's not flashy or viral, but it is real wealth built over time with discipline and realistic expectations. Now, many times throughout this video, I talked about calculating if a stock is overvalued or undervalued. If you want to see how I do that, check out the next video. Hope to see you there.